Welcome to Talk a Tickers, where we break down the earnings calls that move the markets. Today, we are diving into Calix Q4 2025 call, and this one was a real head-scratcher. We're talking record-breaking results immediately followed by a double-digit stock collapse. So, let's figure out what on earth happened.
So check this out. On one side, you have Calix posting a record quarter, beating everybody's expectations on both revenue and earnings. And on the other, the stock gets absolutely hammered, dropping over 14% right at the open. So what did the market see that the headlines missed? Let's get into it.
All right, so first up, let's look at the numbers, because on the surface, they were just fantastic across the board. This is one of those classic beaten-down situations, where a company does everything right and the stock still gets punished. To really understand the why, you first have to appreciate just how strong the what was. Revenue came in at a company record, $272.4 million. That blew past the consensus estimates, which were sitting around $267 million. So, a really solid beat.
And the momentum here is really the key. That record revenue wasn't a fluke. It represents a huge 32% growth from the same time last year. And then you look at RPO, that's remaining performance obligation. Just think of it as future revenue that's already been contracted but not yet booked. That was also up a strong 18%, which tells you their pipeline is looking pretty healthy.
But it didn't stop there. On top of the revenue beat, they also beat on earnings per share. They hit a record high gross margin at 58%, a record RPO number, and record free cash flow. I mean, by any normal standard, this was an absolute monster quarter. So what gives? Where is the disconnect?
Well, here's where things get interesting. The disconnect is all in the guidance. You know, the market doesn't really care about what you did yesterday. It cares about what you're going to do tomorrow. And the entire story, the whole narrative, just flipped on its head when management started talking about Q1 of 2026.
Now, if you look at the revenue forecast, it was actually for growth, which is good. But, and this is the big but, the market zeroed in on the gross margin. The midpoint of their guidance implies a 75 basis point drop, taking them from that record 58% down to about 57.25%. Now that might not sound like a lot, but after 8 straight quarters of margins getting better and better, seeing them suddenly go backward, yeah, that really spooked Wall Street. So, the big question is why? Well, management blamed it on something they're calling dual cloud costs. Basically, they're upgrading their customers to a brand new third-generation platform, and for a little while, they have to pay to run both the old system and the new one at the same time. They said this should be over by the middle of 2026, but for the market, that near-term pain was the smoking gun.
But here's the crazy part. Despite that little hiccup in the guidance, if you actually listened to management on the call, you would have thought everything was amazing. They were painting this incredibly bullish picture of long-term growth, basically telling investors, hey, look past the next 90 days.
And this quote from the CEO, Michael Weening, it just says it all. He came right out and directly pushed back on any idea that things were slowing down. Our demand visibility is at an all-time high. I mean, you can't get much more direct or confident than that, especially with your stock in a freefall.
And they weren't just talking a big game. They backed it up. They pointed to several huge long-term drivers. There's their new AI platform. Then there's this massive opportunity from the federal BEAD program. That's the big broadband infrastructure bill, which they think is a $1 to $1.5 billion opportunity for them. They're still guiding to strong growth for the full year, and to top it all off, they're putting their money where their mouth is and buying back more of their own stock.
So how are we supposed to make sense of these two totally different stories? You've got a record quarter and a super bullish outlook on one side, and a stock that's just getting crushed on the other. Well, it all just boils down to your time frame.
You know, this was a classic Wall Street disconnect. The market got laser-focused on the short term, that Q1 margin dip and those temporary costs. Meanwhile, management was trying to tell a completely different, multi-year growth story built on record demand, AI, and a huge government tailwind. The stock's price reset based on 90 days of bad news.
So for anyone invested or even thinking about it, the path forward is actually pretty clear. You've got a few key dates to circle on your calendar. First, their Investor Day in February. That's where we should get more details on their big plans. Then, in the first half of the year, that cloud migration should be done, which means those dual cloud costs should disappear and margins could pop back up. And then, in the second half, we need to see proof that their AI platform is actually making them money. Okay, so that brings us to the big finale, the next call. How would we pitch this if we were in an investment committee meeting right now? What's the actionable idea? What's the play?
It really all boils down to one simple question. Was this massive sell-off a sign of a fundamental problem with the company, or was it just a bunch of short-term noise that created a fantastic buying opportunity?
All right, so here's the pitch. The thesis is simple. The market totally overreacted to a temporary problem, creating a sweet spot in the stock's valuation. The long-term story is still powered by huge catalysts like their AI platform and that BEAD money. So how do we play it? We think you can start a position right here, after this big drop. And for that reason, we're assigning Calix an outperform rating. We see this sell-off as a compelling entry point for the long term.
And of course, this is not financial advice.